This is Japanese Economic Review Channel. This time, let's take a look at SBI Securities' domestic weekly outlook.
Yeah, and it is a really dense one this week. There's so much to unpack.
I mean, if you were watching the currency markets over the last few days, you probably felt a bit of whiplash.
Oh, absolutely. Whiplash is the right word for it.
Right. Like, we're looking at a landscape where just a single passing comment from a politician about negotiations in the Middle East can instantly tank global oil prices.
Yeah, and completely shift the whole trajectory of the U.S. dollar against the yen.
Exactly. It really makes you wonder, are we even trading on actual underlying economics anymore? Or is the market just, I don't know, a hypersensitive seismograph reacting to whatever headline flashes across the terminal?
It definitely feels like that seismograph when you're right in the thick of it. But the volatility we're seeing for this week, May 25th through the 29th, 2026, it isn't just noise.
Okay, so what is it then?
Well, we're watching a massive collision of three distinct forces right now. You've got shifting geopolitical tensions, a changing of the guard at the world's most powerful central bank, and an absolute mania in the technology sector that simply refuses to cool down.
Refuses. It's wild. So our mission for this deep dive is to sort all of that out. We've got a three-part roadmap for you today. First, we need to look at this week's broad stock market outlook.
Right, figuring out where the money is actually flowing.
Yeah. Then in part two, we're going to dive into the key materials and FX, basically how these inflation and geopolitical fears are testing the currency markets in real time.
Which is where things get really volatile.
Super volatile. And finally, at part three, we're going to walk through the actual weekly timetable to see exactly when these narratives are going to collide with hard data.
So we should probably start with the sheer resilience of the Japanese indices, right?
Yeah, let's do that. Because the pessimism that was dominating the conversation just, a week ago, it seems to have been violently rejected by the market.
Completely rejected. I mean, the T staged this massive rebound.
Right. It closed at 63,339.07. That is a jump of 1,929.78 points. It basically erased all the previous drops.
And the TPX followed suit, right?
Yeah, it rose to 3,892.46.
Well, the speed of that recovery tells us something really crucial about current investors' psychology.
What's that?
We are in a market that is fundamentally terrified of a crash. I mean, we're in a market that is aggressively hunting for a discount.
Ah, the classic dip-buying phenomenon.
Exactly.
The sources highlight that it's really the resurgence of AI stocks that pulled the broader market right back up.
Yeah, because, NVIDIA's earnings are safely in the rearview mirror now.
Right, the big hurdle is cleared. And tensions in the Middle East eased just enough to give investors an excuse to jump back in.
Yeah, they just needed a green light.
But, okay, I have a theory about this whole AI thing.
Let's hear it.
For weeks, analysts have been screaming that Japanese AI and semiconductor stocks were dangerously overvalued, like an engine that was totally overheating.
Right, that was the consensus.
But the absolute second prices dropped, like 5 or 10%. A tidal wave of capital flooded in to refuel it.
Yeah, the demand is just overwhelming.
It feels less like traditional investing and more like a high-speed train, People are just waiting for the slightest deceleration to pry the doors open and jump on board.
Regardless of the destination.
Exactly. They don't even care where it's going.
Well, I'd actually take that theory a step further. I don't think they're ignoring the destination.
Really?
No, I think they believe the destination is a fundamental restructuring of the global economy.
Okay, that's a big claim.
But think about it from an institutional standpoint. When these massive investors look at the capital expenditure plans of the major tech companies, they don't see AI as just a cyclical trend.
Right. It's not a fad.
No, they view it as foundational infrastructure. It's like building the electrical grid or the internet backbone back in the day.
Oh, wow. So a 10% dip isn't a bubble bursting.
Yeah. Exactly. A 10% dip in semiconductor stocks isn't viewed as a warning sign. It's viewed as a very rare entry point into a multi-decade structural shift.
Okay, I get that. But if AI is speeding up again, aren't we ignoring the giant inflation elephant in the room?
A macro reality, yeah.
Because we have the Bank of Japan's mid-June policy meeting creeping up.
Yes, we do.
And BOJ board member Koida has been very vocal recently. She's explicitly emphasizing inflation risk and the need to raise the policy rate at an appropriate pace.
Right, signaling that the era of free money is really ending.
And over in the U.S., we have the brand new Fed chair, Warsh, whose term literally just started. So we have two major central banks actively signaling they might need to cool the economy down.
Which normally crushes growth stocks.
Exactly. So how can equities be soaring when the cost of capital is potentially going up?
Because the market is anticipating a massive capital rotation. But it's totally contingent on one specific geopolitical factor.
Which is?
The SBI outlook points out that if the conflict in the Strait of Hormuz genuinely subsides, exactly. If that subsides, the biggest wild card for global inflation, which is energy prices, starts to deflate.
Okay, so if oil prices cool off, the pressure on central banks to aggressively hike rates also eases.
Precisely. If the energy panic subsides, we could see a truly optimistic market emerge.
So it wouldn't just be AI pulling all the weight.
Right. Capital would start rotating back into traditional sectors that have been battered by inflation fears over the past few months.
Oh, I see. So AI maintains its premium because of that structural demand we just talked about.
Yeah, and the rest of the market gets a lifeline because the energy crisis deflates.
That makes so much sense. And that totally explains why the expected Nikkei range for this week is unusually wide.
Yeah, it's set between 61,500 and 64,500 yen.
That is a massive spread. So the consensus is that the AI tech adjustment has run its course, but they are pricing in a really wide downside.
Just in case the Middle East flares up again.
Right, because if energy prices spike, it shatters that whole optimistic rotation theory.
Exactly. And,
Yeah.
If you want to see exactly how fragile that balancing act is, you really only have to look at the real-time stress test happening in the foreign exchange market.
Our second topic for today, key materials and FX.
Yeah, because the currency market is where these macro theories face actual gravity.
No kidding. I mean, the USD-JPY pair was on an absolute roller coaster between May 18th and 21st.
It was wild to watch.
We saw the dollar surge right up to the 159 yen range.
Right.
The outlook attributes this to three specific pressures: the tensions involving Iran, the corresponding spike in oil prices, and speculation around Japanese deficit bonds.
Yeah, those three things hit all at once.
Now, the oil and geopolitics part makes sense based on what we just went over, but let's dig into that third factor.
The deficit bonds.
Yeah, why would speculation around Japanese deficit bonds weaken the yen so aggressively?
It really comes down to fiscal signaling and supply dynamics.
Yeah.
I mean, deficit bonds are essentially the government borrowing money to cover a shortfall in its budget.
Right, basic government borrowing.
Right. So when speculators hear that Japan might issue more of these deficit bonds, they see two things happening. First, an increase in the supply of government bonds can drive the price of those bonds down.
And when bond prices go down, yields go up.
Exactly. But more importantly, it signals fiscal strain. If the government is borrowing heavily just to cover basic operating costs,
Foreign capital gets nervous.
yeah, they view the broader Japanese economy as less stable. And investors always prefer currencies backed by strong fiscal health.
So they dump the yen.
Right. Capital flows out of the yen and into the U.S. dollar, where yields are already significantly higher anyway, thanks to the Fed.
Which just creates this vicious cycle for the yen. And, when a currency weakens that rapidly and approaches the 160 line, the Japanese government usually steps in.
Or at least threatens to.
Right. We saw Finance Minister Katayama issue a very strong verbal intervention, warning of, quote, resolute action.
Yeah, the classic warning.
And it worked for a minute. It knocked the dollar down into the high 158s temporarily, but then the market just shrugged it off and the dollar bounced right back up.
Like it didn't even happen.
It almost looks like the market is calling their bluff.
Well, it is a high-stakes game of chicken.
Yeah.
The Ministry of Finance knows that actual physical intervention, like dumping U.S. dollars from their reserves to literally buy yen, is incredibly expensive.
And it usually doesn't work for very long. Right.
Exactly. Its effects are usually short-lived if the macroeconomic fundamentals haven't actually changed. So verbal intervention is basically a psychological tool.
They're just trying to spook the market.
Right. They try to introduce enough risk into the market to scare off speculative short sellers. But algorithmic traders and institutional desks, they constantly test those boundaries.
So they pull back when Katayama speaks.
Yeah, they recalibrate, and then they push forward again to see if the ministry will actually pull the trigger.
Wow. And while that game of chicken is happening in Tokyo, global leaders are throwing wrenches into the gears from the outside.
Which is exactly what we saw with the U.S.
Right, this is what I was referencing at the very beginning of the deep dive. U.S. President Trump stated that negotiations with Iran were in their final stages.
It's just a single headline.
And that single headline sank oil prices and immediately weakened the dollar against the yen.
Plummeted.
But then, literally hours later, we got mixed U.S. data. Jobless claims were lower than expected, which shows a strong labor market.
Right, which boosts the dollar.
But the non-manufacturing PMI was sluggish, so the market had to digest all of that conflicting information, and it eventually settled the currency pair around 159.35.
Which sets up our forecast range for this week.
Right. The outlook forecasts a range of 157.20 to a 161.00 yen. That is wide.
The wide forecast really just reflects the battle between those fleeting political headlines and the underlying economic floor.
Let's talk about that floor, actually. The SBI outlook notes a technical support level. It's the 26-week moving average, sitting right around 157.2 yen. Why does a somewhat arbitrary historical average act as a physical floor for the currency? I never quite understood that.
It's because modern trading isn't just humans making discretionary calls anymore. I mean, it is heavily driven by algorithms and quantitative models.
The machines are running the show.
Yeah, pretty much.
What?
The 26-week moving average represents half a year of consensus pricing. So for an algorithm, it acts as a critical pivot point.
Oh, I see.
If the price drops to that average, automated systems often view it as a reversion to the mean. So they automatically trigger buy orders.
Which creates artificial support.
Exactly. But beyond the algorithms, the fundamental reality is what truly limits the dollar's downside.
The inflation piece.
Right. As long as global oil prices remain relatively elevated, U.S. inflation will remain sticky.
Meaning the new Fed chair, Warsh, is totally boxed in.
He is.
He can't aggressively cut rates if inflation is sticky. And if he can't cut rates, that maintains the massive interest rate gap between the U.S. and Japan.
Exactly. The fundamental interest rate differential is the tide. The headlines are just the waves on the surface.
I like that. The tide versus the waves. So if the fundamentals are the tide, we need to know exactly when the market is going to get its next reality check on those fundamentals.
Which brings us to part 3.
Yes, the weekly timetable. Let's look at the actual calendar for the week ahead and trace when these narratives are going to be tested by hard data.
You know, the pacing of this week's timetable is actually really fascinating.
How so?
It starts with an almost eerie calm on Monday, and then it builds into this relentless cascade of critical data by Thursday and Friday.
All right, let's break it down chronologically. Monday, May 25th, is the calm before the storm.
Yeah, very quiet.
Markets in the US, the UK, Hong Kong, and Korea are all completely closed for holidays.
Right.
And in Japan, the data is fairly light. We have nationwide department store sales coming out.
Which gives us a nice quick pulse on domestic consumer spending.
Yeah. But the more interesting item on Monday is the auction of a 5-year climate transition bond.
Oh, definitely. That bond auction is a crucial piece of Japan's broader GX, or green transformation strategy.
The push for carbon neutrality.
Right. The government is trying to mobilize massive amounts of private capital to transition the economy. So auctioning a 5-year transition bond right now is a major test of market appetite.
Especially with yields where they are.
Exactly. With inflation rising and the BOJ hinting at rate hikes, the Ministry of Finance really wants to see how much of a premium investors will demand to hold specialized, green-focused debt compared to standard government bonds.
Got it. So Monday is really a localized test of borrowing costs in Japan.
Yeah.
But the global testing really begins on Tuesday, May 26th, when the U.S. markets finally reopen.
And we immediately get hit with data.
A heavy dose of U.S. housing data. We've got the FHFA House Price Index and the Case-Shiller Index alongside CB Consumer Confidence.
Right.
But wait, why is the market zeroing in on housing data when the broader narrative is all about AI and energy?
Because shelter costs are the stickiest component of inflation.
Oh.
Yeah. If you want to know what Fed Chair Warsh is genuinely worried about behind closed doors, it's housing. Real estate prices dictate rent, and rent makes up a massive, massive portion of the core inflation metrics.
So if housing doesn't cool down, inflation doesn't cool down.
Exactly. If the Case-Shiller Index shows that home prices are continuing to climb, it tells the Fed that domestic inflation is still running hot, regardless of what happens with oil in the Middle East. It totally removes their flexibility.
That makes a lot of sense. Also on Tuesday, we get Xiaomi's earnings in Asia.
That's a big one.
Yeah, that feels like a vital proxy. I mean, Xiaomi isn't just selling smartphones anymore. They are deeply embedded in the consumer electronics and EV spaces.
Right. They are everywhere.
So their forward guidance will give us a very clear read-through on the health of the Chinese consumer and broader Asian tech demand in general.
which ripples directly into Japanese semiconductor suppliers.
Exactly. So Tuesday sets the stage perfectly for Wednesday, May 27th.
And Wednesday's huge.
In Japan, we get the Corporate Service Price Index in the morning, which tracks inflation between businesses. But the real center of gravity on Wednesday is the massive slate of U.S. tech earnings.
Yes.
We have Salesforce, Marvell Technology, and Synopsys reporting.
This is really the moment of truth for the AI resurgence theory we discussed earlier.
How so?
Because these aren't consumer-facing brands like Apple or Netflix. Marvell and Synopsys are the plumbing of the AI boom.
Infrastructure.
Right. They provide the networking chips and the electronic design automation software that make these massive data centers possible. If their guidance is strong, it validates all those dip buyers.
It proves the infrastructure build-out is still accelerating.
Yes. But on the flip side, if they report that enterprise clients are delaying their capital expenditures or that the return on investment for these AI build-outs is taking longer than expected.
Then that foundational narrative cracks.
Exactly. And a crack in that narrative on Wednesday would be absolutely disastrous because of what happens on Thursday.
Yeah, Thursday, May 28th is an absolute data gauntlet.
It really is.
The Indian market happens to be closed, but globally, all eyes are locked on the U.S. We get the Q1 GDP revision, durable goods orders, new home sales, and earnings from Costco and Dell.
Just a barrage of data.
But the titan of the day, the one everyone is waiting for, is the U.S. PCE deflator.
Yeah, this is the moment the market has been holding its breath for since Warsh took over the Fed.
Just to clarify, the personal consumption expenditures deflator is the Federal Reserve's preferred inflation gauge, right?
Right, because it accounts for substitution, meaning it tracks what consumers are actually buying as prices change, rather than just looking at a fixed basket of goods.
Got it. So this is Warsh's first major trial by fire.
Definitely. The market is desperate to map out his psychological pain threshold.
What do you mean by that?
Well, if the PCE print comes in hot, will he immediately pivot to a hawkish stance and threaten more rate hikes? Or will he tolerate a period of sticky inflation just to protect the labor market?
That is the defining question for the U.S. dollar right now.
It is.
And notice the earnings on Thursday, too. Costco and Dell. You have Costco representing the ultimate pulse of the squeezed middle-class consumer.
Right, the everyday spending.
And then Dell representing corporate IT spending on AI servers.
Yeah.
We are getting a simultaneous health check on Main Street and Silicon Valley on the exact same day the Fed gets its inflation report.
It is a massive day. And just as the market tries to digest all of that, Friday, May 29th, snaps the focus violently back to Japan.
Yes, it does. We get the unemployment rate, retail sales, and industrial production. But the most critical piece of data for the entire week drops here.
The May Tokyo CPI.
Yes. And this feels particularly dangerous because April's national CPI was surprisingly weak.
Right, it caught people off guard.
The Tokyo CPI acts as the leading indicator for the rest of the country. If the Tokyo numbers suddenly show inflation spiking back up, BOJ board member Koida's warnings from earlier in the month go from being cautious rhetoric to an immediate, actionable reality.
And rate hike expectations for the BOJ's mid-June meeting would absolutely skyrocket.
Which would shake up the currency again.
Oh, definitely. And don't forget, Friday at 19.00, the Ministry of Finance releases its FX intervention data.
Oh, right.
The market will finally see hard proof of whether the government was secretly intervening during those wild currency swings earlier in the month, or if Katayama's verbal warnings were purely psychological.
Wow, so they have to show their cards.
Exactly.
You know, looking at the schedule, if you are an investor sitting on an unhedged portfolio, meaning your international investments are fully exposed to the raw currency swings between the dollar and the yen without any protective contracts, there is a specific 24-hour window this week that acts as a crucible.
You're talking about the window between Thursday night in the U.S. and Friday morning in Japan.
Yes. Walk us through the mechanics of that 24 hours. Like, how could that specific window break an unhedged portfolio?
Okay, let's assume you hold U.S. tech stocks. On Thursday night, the U.S. PCE deflator drops.
Okay.
If U.S. inflation is unexpectedly hot, bond yields spike, and the U.S. dollar strengthens violently.
Which you might think is good for your dollar-denominated assets.
Right. But if tech stocks sell off because investors fear Warsh is going to hike rates, the actual equity value of your portfolio plummets.
Ouch.
And then, just hours later on Friday morning, the Tokyo CPI is released. If Tokyo inflation is surprisingly weak, the BOJ backs off its rate hike plans.
which means the interest rate gap between the US and Japan widens even further.
Exactly.
So the yen could just fall through the floor, blasting right through that 161.00 ceiling we talked about earlier.
It could. But conversely, if U.S. inflation cools down on Thursday, but Tokyo inflation comes in blazing hot on Friday, the yen could surge in strength.
Wait, if the yen rapidly appreciates against the dollar?
The value of your U.S. tech stocks, when converted back into yen, just collapses.
Oh, wow. It would completely wipe out any gains you might have made from a tech rally.
Yes. In that single 24-hour window, the core monetary policy trajectories of the world's largest and fourth largest economies will literally collide.
It is the ultimate reality check. The market sentiment we discussed at the top of the show is finally going to be forced to answer to the macroeconomic data.
It's the defining dynamic of the week.
As we wrap up this deep dive into the week ahead, I really want to leave you with a final thought to ponder while you watch the boards.
It's a lot to think about.
We just discussed a landscape fraught with extreme geopolitical volatility, fluctuating oil prices, and the very real threat of prolonged, sticky inflation under a brand new Federal Reserve chair.
Yep.
By every traditional metric, this is an environment that should heavily penalize growth stocks and speculative tech. Yet, despite those glaring warning sirens, institutions rushed in to buy the dip on AI infrastructure almost immediately.
They couldn't buy fast enough.
Right. So, are we witnessing a temporary delusion? Or are we entering an entirely new era where the structural demand for artificial intelligence is so overwhelmingly powerful that it effectively overrides traditional macroeconomic gravity?
That's the million-dollar question.
Is the promise of building the next industrial revolution making us completely numb to the risks of the present? It is definitely something to keep in the back of your mind as the data rolls in this week.
It might truly be the most important question facing modern capital markets today.
Thank you for watching the Japanese Economic Review. We look forward to having you with us again.